Stephen, we're hearing a lot recently from our sponsor clients about underwater incentive equity at their portfolio companies and what they can do about it. Why is that so much of a problem right now?
It's a good question, Wells. I think, the climate that we're in, high interest rates, and management equity is critical for the private equity world. It's the thing that keeps management engaged, driving up the value of the companies and not thinking of going elsewhere. Mm-hmm. So if that management equity doesn't have any value, they're no longer incentivized to stay. And so I think portfolio companies are desperately trying to figure out ways of re-incentivizing the management to keep them in place and to keep them focused. Mm-hmm. But it's quite a difficult thing to do. What are you seeing?
There's no silver bullet, right? It depends on what jurisdiction you're in, depends what sort of incentive equity you're dealing with. In the US, typical portfolio company, we're dealing with profits interest, which makes things much simpler. Easier. Yes. No tax on grant, no purchase price. It makes it relatively easy to restructure the incentive equity to re-incentivize management. Yeah. You can issue a new series with a lower threshold, make it more likely to be in the money, and not have negative tax consequences.
Yeah, so easy for you guys.
Yes, much easier than the UK.
Well, we just don't have that, unfortunately.
Right, it's unique. It is.
As you know, the managers will have paid for their equity in the UK, so if their equity is worth less than they paid for it midway through the investment cycle, they're an unhappy bunch.
Yeah, that would be a disincentive, not an incentive for sure.
And we have to do some creative thinking to re-incentivize. I mean, I think one thing that you often see is if the management equity only participates after the sponsor's made a return, an IR hurdle, we can maybe reduce that hurdle to boost the value of the equity. Another is to put the management equity higher up perhaps alongside the shareholder debt. The sponsor will have a ton of debt, so it's going to make a return regardless of whether the value breaks into the equity. So to try and get the management realigned, put them up at that level. And another is to persuade the sponsor to reduce the interest rate on its debt, just less of a drag on profits. But all of those only work if there's any chance of the equity having value on an exit. But if there isn't, what do we do?
Well, as you know, I love cash plans. I know you agree. But sometimes people get hung up on the fact that it's ordinary income and not capital gain.
But it is certain. That's the great
thing.
You
have greater certainty and it's easier to understand.
Yeah.
Cash is king, as you like to say. Everyone understands it. That doesn't mean it has to be simple. That doesn't mean that it has to be a fixed dollar amount. A lot of sponsors put in place what they call a carve-out plan. Yeah. You reset expectations and you say, okay, if we have a transaction above a certain size within a certain time period, we're going to carve out 10% of proceeds for management. Okay, divvy that up into the plan. And you can add features, you might want to leave, you might not be certain whether the equity is going to break into the money, and so you can leave it outstanding. And you can build a feature into your cash plan that says, look, if you do end up benefiting from the equity, we can reduce the cash plan dollar for dollar.
No double dipping.
And so that avoids the double dip. So that's my preferred approach. Sometimes we see things that are a little bit more exotic, putting in new plans at a different level of seniority.
Yeah, we sometimes see them at midco level because that's going to be ahead of all the shareholder debt, but there's lots of consent issues around that and other things you need to think about.
Yeah, you have all kinds of corporate issues. I know in the UK you'll often have tax issues. Yeah. Sometimes you see folks transfer debt to management, do other sorts of things, and really get into the weeds on it. But I think the cash plan makes a lot of sense.
I think you're right. Absolutely.
Thanks, Steve.